Stocks continue to fluctuate today as the market digests today's economic numbers and AIG's quarterly loss. Jack Ablin is Chief Investment Officer at Harris Private Bank. He joins us now from Chicago with the details. Jack, welcome back to Bloomberg News. Always good to see you.
Thanks, Mark.
Jack, what do you make of these numbers today? Give us a sense of what they're telling you.
Well, in general, Mark, the economic backdrop has actually shown some improvement. What I like is that a lot of the improvement is coming from the wholesale, manufacturing sector, which really hasn't been a big beneficiary of the stimulus program. So if we can get manufacturing and some of the business leaders to spend, that's certainly an encouraging sign to suggest maybe we have a sustainable growth.
Jack, sales of previously owned homes in the U.S. unexpectedly declined in January for a second month. Consumer confidence falling this month from January. But the ISM survey showing business activity expanded more than anticipated. Take us through this maze. How should investors sort through these numbers?
Well, you're right. I mean, the housing market is pretty moribund, and we saw that not just today, but we saw it really during the course of this entire week. Mortgage applications are down, new home purchases are down, existing home purchases are down. So clearly, not much activity going around here, and it's remarkable that mortgage rates as low as they are, and the mortgage payments, what we've calculated, median mortgage payments are the lowest percentage of discretionary income since we've been able to track back to the mid-70s. So there's certainly an inducement, but unfortunately there's just little demand and a lot of extra supply.
Jack, about that housing data again, without the government's extension of a tax incentive which helped drive purchases, was there really much of an improvement?
Well, that's a good point, Mark. It's hard to really know. A lot of the inducement was at the lower end, the new home purchase of, the first-time home buyer. But we did see some activity across the spectrum among houses that arguably would not be homes purchased by initial buyers,
right.
And given that the credit would have been a much smaller portion, a little incentive. So there is some activity there.
Yeah, and Jack, and one of the reasons that home prices are declining is distressed sales.
That's it. I mean, the supply, it's foreclosures. It's then there's this latent supply out there where people want to sell their homes and just waiting for the market to firm up a little bit so they can put their home on the market. So I think that while housing prices are certainly situated at fair value to arguably some measures below fair value, I just don't see any impetus right now because of the overhang of supply that prices are going to ramp up that much anytime soon.
Well, when the Fed ends its purchases of mortgage-backed securities, how big of a challenge is that going to be for the housing market, not having that backstop?
Well, again, this isn't. They're not removing their guarantee. Freddie and Fannie are still going to have this implicit government guarantee behind it, and so really, it's what we're probably going to do is see the Fed transition away as the marginal buyer, and that's going to move into the private market. I don't really see a big uptick in mortgage rates as a result of that, Mark. In fact, I watch, for example, the relationship between conventional mortgage rates and jumbo mortgage rates, and that spread is narrow and narrowed a little bit, and the Fed certainly is not coming in buying jumbos. So I think that this handoff should be relatively smooth, and as long as the government backstop is there, buyers will likely step in.
Well, as we mentioned at the beginning of this interview, consumer confidence is down. Is that due to the fact that even though the economy is forecast to grow about an average of 3% this year, it's still not generating jobs at a quick enough pace?
Yeah, that's it, Mark. The key here is at 3% growth rate, we generate about 170 to 170,000 jobs a month. I'm going to argue we probably need to grow it somewhere less than that, 2 to 2.5%, because we've got to pay down some debt and retire some of this overhang. And then at 2 to 2.5, we generate between 100 and 120,000 jobs a month. And considering that it takes about that number just to keep the unemployment rate from going up, that suggests to me that we're going to see a 9 handle on unemployment throughout probably this year, and maybe start to see some incremental progress next year. But that keeps the Fed on the sidelines, I think.
Jack, at this point, is there enough safety margin in big cap stocks?
I think there is. Keep in mind, Mark, that, for notwithstanding this huge rally that's enveloped most of the equity markets last year, the large cap blue chips really didn't participate. If you consider GE and Walmart and McDonald's were probably either up less than 5% or in some cases down, that the rest of the market may have caught up to it. So I think the U.S. large cap is probably not only a safe place to be, given all of the events that are going around, but also could be poised to actually leverage on some of this export volume that we're starting to see.
What average are you looking for this year?
I'm sorry?
What average are you looking for in large cap stocks?
In terms of returns?
Yeah.
I would say if we could get a 10% return out of the market, that would be a success, particularly in the U.S. large cap.
Yep. Jack, let me close. We have about a minute left. Yesterday's healthcare summit in Washington. Should investors in healthcare stocks read anything into that meeting?
Well, I think they can read stalemate, and anyone that wants to invest in health, likes health. We currently do not have healthcare on our attractive sector list, but those investors who are interested in healthcare and worried about event risk of legislation coming through anytime soon probably can probably take that one off their worry list right now.
Any sectors that you're watching?
Sure. So the sectors that we like, although I have to, just preface this by saying we rebalance at the end of the month, and so that's going to rebalance over the weekend. But my sense is they'll probably remain the same. It would be the pro-cyclical sectors. We still like consumer discretionary, finance, industrials, and technology. So my guess is we'll likely stay with those as we move into March.
Jack Ablin, Chief Investment Officer at Harris Private Bank, joining us from Chicago. Jack, it's always good to talk to you. Thank you so much.